Hello, good morning, and thank you very much for joining us on this Friday morning, January the 18th. Finishing a week which has shown another week where we have risky assets once again moving higher. Trade talks remain one of the key themes. We have seen political moves both in the US from central banks and from China trying to underpin the market. And so far the market is responding, and we're seeing higher prices. If we start off just looking at the S&P, we have now retraced half of the sell-off from October to December. We moved above 2,630 yesterday, and we're staying above that level overnight. The main reason is for the move up yesterday was Treasury Secretary Newton in the Wall Street Journal, not him quoting, but he was quoted as having raised the possibility of lowering sanctions against or tariffs against China in order to speed up the process. That was, however, later denied by the Treasury Department, but nevertheless, the market is really focusing currently on the prospects for a deal to be made. You can argue with the US government shutdown now entering its 26th day that Trump may be looking for a win on the international stage when the domestic stage is so gridlocked as it is at this stage. So the trade negotiations are ongoing. A lot of problems still to iron out. So we haven't seen the last on that one, but at least the market's responding accordingly. So for now, the best run in stocks since last July, and staying with the best runs. If you take a look at sterling, it's really been a good week there as well. We had the best run in a year. What we have seen now over the past couple of days is after the defeat in Parliament earlier this week, Prime Minister May is now talking to rival politicians to find a way forward. She must declare her Plan B to Parliament on Monday, and I think at this stage neither the UK or the EU wants a hard Brexit. What probably did the additional rally overnight and since yesterday was basically Jeremy Corbyn, the opposition leader, out raising voicing that potentially second referendum could be on the cards, and the market is looking for, if that was the case, then they're looking for the Remainers to win. So that's bringing some relief to cable. So we need to look at this 130 level, which is quite key at this stage. It's a big psychological level, but a strong week for sterling so far. But as I said, the Plan B has to be put forward on Monday. So probably still plenty of volatility to come on that front. With all the risky assets in demand, you could argue that there's not really a place for gold to be at this stage. But if you look at the chart, we can see that we are still hovering just below the 1300 level. But you can also see we are getting close to a decision time, because this range is getting tighter and tighter. And for this to gauge there, we really need to keep an eye on stock market. So if we continue to see stock markets move higher in the short term, there is a risk we may see a small break to the downside. But given the way that gold has been behaving throughout January, when we have seen stock markets rally quite strongly, we have seen a dollar relatively stable, that does indicate that the underlying demand is still there. Gold moving into ETFs are pretty close to a 5-year high, so that continues to provide some support for gold. If we just stay on the commodity theme, because what we see right now is really quite high correlations. That a lot of the focus in the market is really all about trade talks. It's about the global growth outlook. And if you take a look at this correlation that I brought with me today, you can see this is the correlation, the 30-day rolling correlation between WTI crude and the S&P. And it hasn't been this high since 2011. So basically, if you're trading oil, you need to watch the stock market very closely. And I think one of the reasons why also oil is right now is not responding responding to the increase we're seeing in the stock market. It's really the fact that one of the reasons why we did sell off quite strongly back in December and since October was the risk to global growth. But if you can look at this table or chart I brought with me here, this is so far we've had the monthly surveys or reports from OPEC and the EIA, and they're both basically not seeing any slowdown in demand growth into 2019. We got the IEA today before noon, so we're going to see what their number is. Obviously, they vary, but the trend is pretty sideways. So we have yet to see any significant negative impact on demand. And as long as that stays the same, then crude oil will find some support, because at this stage OPEC Plus, which includes Russia, they are doing their best to cut production in order to stabilize the market. And just returning to the chart, you can see, as we mentioned now for the last week or so, we are back in the old consolidation range. So if you look at the Brent crude, which I have here, the 57.50 to 64 is really the range. Probably some resistance as we move up towards the 64 level, because we still need to see some more developments on the potential demand side. And I think before we finish off with the calendar, I think we definitely need just to take a look at China. We are just a couple of weeks away now from the Chinese New Year, where the markets will shut the biggest annual move of people across from the cities into the countryside, and that will basically render Chinese out of the market for a while. But in approach to this, we have seen quite a strong move in the Chinese renminbi, and I think if you look at the chart, at this stage, it really is one of the best barometers for how things are developing on the trade front. We have seen the market come down all the way down to below 6.75 against the dollar, the renminbi, as a little bit of recovery this week. The dollar, a little bit of dollar strength, but look out for that 6.75 area. If it breaks, then we could see some additional Won renminbi strength. So really, next week on Monday we have retail sales, industrial production, and GDP out. And that will probably set the stage ahead of the Chinese New Year. Right, let's finish off with the calendar. Peter is not here today, but he will be posting the earnings watch for next week on home.saxo, so you can find that there later today. But the key events today, we got retail sales from the UK and CPI from Canada. Later on, we are going to see the IEA report, as I mentioned. It should be out just before noon. But obviously, we do have quite a lot of uncertainty right now due to the government shutdown. As I mentioned there at the bottom, we are basically seeing an increased number of economic data from the US not being published, and you can see some of the numbers there which we are missing out on, and it does obviously leave the market guessing somewhat as to the impact of this current shutdown we're seeing in the US. So plenty of things to look out for next week, and as I said, China on Monday will kick off the week with some important data. That's it from me this Friday. We'll be back again same time on Monday. Thank you very much.